how close are you watching what's been happening in the gilts market and the fact that, one day, in 2 days, the long end sold off 100 basis points, and then in 1 hour it rallied back 100 basis points. The stabilization measure announced by the Bank of England, how important is it for your market that long end gilts are under control?
Very important, because it drives swap rates. It also drives where the Bank of England or where the market thinks interest rates are going to. At the moment, the market is now discounting interest rates going up towards 6%. Yeah. And that was clearly, before this situation last week, we were probably thinking 3.25%, maybe 3.5% would be the peak. Inflation peaking maybe October, November this year at around 11%. Now, clearly that's been thrown out because we don't know where sterling's going to go, how sort of inflationary a weak sterling could be for the economy. So, stability in the gilt market is very important for those reasons, because it can give us some sense as to where interest rates may ultimately land. And obviously that will have a big impact on mortgage rates, on consumer spending. So it's all linked in. So yes, we watch the gilt market just as much as we watch the equity market.
Yeah, and I guess the other angle there is the FTSE is known for being a high dividend market, high yielding. But in an environment where bond yields are so high, doesn't that make equities less attractive?
It does indeed, yes. Fortunately, 45% of the dividends paid by FTSE 100 companies are actually paid in dollars, so there is some sort of benefit in that way. But you're right, and when we saw it with the real estate companies over the first couple of days of this week, cap rates in real estate stocks are 4.5%. If you've got interest rates at 6%, it's very difficult for real estate stocks to look attractive.
Yeah, well, I actually want to ask you about real estate. That was going to be my next question. With interest rates poised to go up to 6 percentage points, you hear the likes of mortgage lenders pulling deals, reevaluating their stance, probably going to get a bumper hike at this November 3rd meeting. What are you advising clients to do on real estate exposure now?
Well, real estate stocks are obviously discounting quite a lot of bad news. On average, the commercial stocks in the UK are trading at about a 40% discount to net asset value, which is sort of, when you look back in history, one of the widest levels. I think what we would expect to see in real estate stocks is rents basically go up to compensate for higher costs of funding. The other thing we have seen is a lack of transactions, because a lot of commercial real estate stock deals are obviously funded by debt, and obviously debt's becoming more expensive. So some of those transactions are clearly being put on ice for the time being, and I think that's adding to the negativity in the market. But if we get a sense that interest rates may not get to 6, may get to 5, and that's dependent on a whole range of factors like the gas price through winter, what sterling does, then there's clearly some value coming back into that real estate market. In terms of mortgages, then obviously, there are 11 million mortgages in the UK. About a third of homes have mortgages. 80% of mortgages are fixed at the moment. So you've basically got 500,000 people rolling off each. Yes, you've got 500,000 people rolling off fixed each quarter, and clearly those rates will go up. The banks have pulled them because swap rates have moved up, not because they don't want to sell mortgages. And I think it's, we expect those offers to come back, albeit at higher levels.